king of specs, in my opinion, was my own ill-fated QuantumScape. That peaked out in December 2020. It was the leader of the gang. It came at 10 like all SPACs, went shooting up to 132. At 132, it had a market cap of 55 billion, bigger than General Motors and bigger than Samsung. QuantumScape, a research lab, a very good research lab working on a solid-state lithium-ion battery, half the weight and volume, rapid charge, no fire. It would be very nice if it worked out, but back then it still had 4 years to go before it had any sales or any profits, and it sold for more than General Motors. You have to admit that is a candidate for the biggest spec of the cycle, bigger than anything I can find in 1929 or 2000. Got to remember in 2000 that the pet.coms were scores of millions, or in a few cases, a few hundred millions. This was 55 billion. Adjusted for inflation, adjusted for anything, that was a monstrous demonstration of the ability of the market to think deep into the future and have positive thoughts. Anyway, that peaked out in December 2020. In January 21, the number of new issues peaked. In February, the outperformance of the new issues peaked out. And in February, also ARK peaked. ARK, a exchange-traded fund of about 30 growth stocks that are very early stage growth. Most of them had no earnings. So that was exactly where the termites would be expected to go to work. And then a month or two later, the meme stocks with little or no earnings, like AMC and GameStop, they peaked out. And the whole Russell 2000, although it technically peaked in November, by early February of 21, it was about the same. It plateaued for over 10 months, almost 11 months of 21 before going down. So they had been rolling over, and 40% of the NASDAQ before December 21 were down 50% or more. So anyone who was into deep speculation knew very well that the bubble had started to lose air long before the end of 21. Okay, so that's one point I'd like to make. Secondly, the first half of this year is about as fast as stock markets ever decline. I remember seeing that the first 4 months was the fastest decline in the S&P since 1939, when I was 1 year old and they were preparing for World War I. So that's a pretty good excuse to go down. And this was the fastest decline. This is about as fast as markets go down. And they always have good rallies. There's nothing as quick and spectacular as a bear market rally. They had one in late 1929 to early 1930, an absolute doozy of 45%. And of course, with historical hindsight, they signify very little, but at the time, they frighten the pants off the bears, and they give hope that all is over, all is forgotten, and it's back to the races. And I suspect we may very well have a pretty decent bear market rally as we sit. I wouldn't be surprised if this went on for at least another month. In terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, that the S&P would have declined by 50% from the peak in real terms. So you do have to adjust the stock market for inflation. And also the trend. The trend in the market is a little over 4% a year. And as time passes, you should put that into the fair value. So a year from now, when the bear market might end, the trend line value would be almost 3,000 on the S&P. Of course, there's no rule that says you stop at fair value. Typically, in previous big bubbles breaking, they go down below that. They went down below, of course, in the housing bust of 2009. And they went down in every great bear market break, they went below trend, except Alan Greenspan's specialty in 2000. In 2000, the S&P was heroically overpriced. It came down 50%, but at 50% decline, it was only fair value. It only hit the trend and then bounced as the Fed raced to re-stimulate. The NASDAQ went down 82, and that's a lot of pain. And it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that. I don't include the classic FANGs as being in the super speculative category. I think you could throw Tesla in at its peak. That was super speculative, great company, but a bit of a silly price there. But the others, like Amazon and so on, they're great companies, but I wouldn't have included them as super specs. And yes, they're down quite a lot. It's hard in a bull market to get your brain around what happens in a bear market. Let me go back to Amazon. Amazon in the 2000 bust didn't just come down. As its sales continued to grow, of course, in those days, it didn't have earnings because it was running on borrowed resources. It didn't have to. It was still growing like a weed. It came down 92%, with strongly rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. How is it possible it came down 90%, 92? So think about that sometimes as you go to bed. I like to say 80% of the time the market is pretty sensible and doing a possibly good job of estimating value for all the companies. A little under 15% of the time, it gets carried away with optimism. And by the end of that time, has nothing to do with actual earnings. It's all in the head, projecting out hundreds of years into the future, assuming that perfect conditions will stay perfect forever. Every bubble takes place with near perfect conditions and huge profit margins. And the market runs with that and assumes it will stay there forever. And of course, conditions mean revert, profit margins mean revert, and good times become bad times. And that is a problem. And the remaining 5%, the market gets carried away on the downside and starts to be completely irrational, as it was beginning to be in March of 2009. It was getting pretty silly, pessimistic. I wrote a piece, Reinvesting When Terrified, that by sheer luck came out the day the market hit its low. And it said, get a policy, get a plan, present it to your committee or yourself, and start to throw your money back into the market. You feel paralyzed, everyone always does, and now's the time to wake up, the market is cheap. And of course that happened in 1974 and 82, which were classic lows when the market got down to 7 PE. And what I call terminal paralysis sets in, where you're so frightened you can hardly move, you can hardly get to work, forget buy stocks. And that's, of course, as Warren Buffett would have said, that's exactly the time you have to do it. And it's only 5% of the time. They're much quicker than the crazy bull markets. I expect the Fed to be behind the curve, to be deep into optimism, and it doesn't really have a clue about market bubbles and the damage they do when they break. They've been eager now since early Greenspan to encourage bull markets because they help the economy. They really do. And they always forget that the bear markets to go along with them hurt the economy at just the wrong time. So if I'd been asked to bet, would the Fed get inflation wrong when inflation came along at any time, I would have said, of course, they'll miss it, they'll be late, their responses will be pretty ill-judged. The Fed's record is terrible. What is impressive is how much room they have been cut by the market. I mean, the market is incredibly forgiving to the Fed. The Fed happened for 20 years, 25 years, to benefit from that amazing era as 500 million Chinese raced into the big cities and were plugged from marginal farming into highly profitable industrial system. And then they joined the World Trade Association and made everybody's stuffed dogs and everybody's iPhones for that matter. And during that phase, 500 million extra Chinese, 200 million Eastern Europeans plugging into away from communism into capitalism. That was a golden era, Goldilocks, if ever there was one. And the Fed got to take credit for that. A Prime Minister of England once, Mr. Wilson, got re-elected because England unexpectedly won the World Cup at soccer. And he got credit for it. I mean, the president gets, in the end, credit for everything, good weather. He takes the shock for inflation. These things are all way bigger than the president of the United States. But the president and the Fed gets to enjoy the environment. So this Fed had a wonderful environment. They did nothing right, but they were seen to be presiding over low inflation and decent growth. The growth rate actually has slowed way down since Greenspan. It was averaging 3.5 before Greenspan and averaging 2.5 afterwards, and today more like 1.5. So it's done nothing in terms of increasing the growth rate, but superficially it felt like a golden age because asset prices went up. Asset prices went up because inflation came down and rates were allowed to come down. And in the end, rates were forced down. And low rates make leverage cheap, make private equity deals wonderfully easy and profitable, and they push up the price of real estate and they push up the price of stocks. And that's the way it was. And the Fed gets credit for that, and it's due none. Its demerit accrues from the fact that it kept on pushing down interest rates far too long and dangerously, increasing inequality, which, as I like to say, is the greatest poison in the system these days. And it does damage the degree of inequality we have in the US now, does damage the strength of the economy. And it is probably part of the reason why the growth rate has slowed and continues to slow.